There is a dangerous assumption spreading through the precious metals community right now. And what makes it dangerous is that it sounds completely reasonable. Thousands of silver stackers believe that if they never receive a tax form, then they have nothing to worry about. They believe that if they sell a little at a time, nobody notices. They believe that silver exists outside the financial system in a way that protects them from reporting requirements. And in 2026, that belief could become one of the most expensive mistakes a stacker can make. The truth is that the biggest threat to most precious metal investors is not inflation, not market volatility, and not even the possibility of lower silver prices. The biggest threat is misunderstanding the rules that apply when the time finally comes to sell. Most people spend years building a stack. They compare premiums, search for the best deals, watch silver prices every day, and debate whether rounds are better than government-minted coins. They study economic cycles, listen to market experts, and prepare for inflation. But when it comes to taxes and reporting requirements, many of them spend almost no time learning the rules. That creates a problem, because every investment eventually reaches a moment when it must be sold. One day you need cash for retirement. One day you want to help your family. One day you decide the price is high enough to take profits. And that is when a lack of preparation can become extremely costly. The IRS reporting clarification that gained attention in 2026 is not a dramatic new law, but it has exposed how many investors misunderstand the system. Some people immediately heard about reporting thresholds and started searching for ways around them. That mindset is exactly backward. Smart investors do not ask how to avoid reporting. They ask how to stay compliant while protecting their wealth. Those are two very different approaches. One approach is built on rumors. The other is built on understanding. Imagine two silver stackers who started buying metal years ago. Both accumulated the same amount of silver. Both benefited from rising prices. Both are now sitting on significant gains. The first investor kept every invoice, recorded every purchase date, and maintained a simple spreadsheet showing cost basis. The second investor relied on memory, threw away receipts, and assumed taxes would somehow work themselves out later. When the time comes to sell, the first investor knows exactly where he stands. The second investor is suddenly scrambling to reconstruct years of purchases. The difference is not intelligence. The difference is preparation. One of the biggest misconceptions in the precious metals world is the belief that physical silver somehow exists outside the reach of tax law. Many people buy silver because they distrust central banks, worrying about inflation, or want tangible assets that cannot be printed into existence. There is nothing wrong with those reasons. Physical ownership offers advantages that paper assets cannot provide, but independence from financial institutions does not mean independence from tax obligations. The moment you realize a gain, tax considerations become part of the equation. Consider what happens during a strong silver bull market. Prices rise rapidly. Excitement spreads through the community. Investors who have patiently held their stacks for years suddenly find themselves sitting on profits far larger than they expected. At that moment, emotions begin to take over. Some become greedy and wait for even higher prices. Others become fearful and rush to sell before the rally ends. Unfortunately, emotional decisions often create financial consequences that investors never anticipated. A stacker who accumulated silver at $20 per ounce may feel thrilled selling at $40 per ounce. On the surface, it looks like a simple success story. But what matters is not only the profit. What matters is the after-tax result. Many investors focus entirely on the selling price while ignoring the tax impact. A gain that looks impressive can become much smaller once taxes are considered. That is why experienced investors focus on what they keep, not simply on what they make. Another mistake that catches many stackers off guard is poor record keeping. It sounds boring, and it certainly does not generate excitement on social media. But record-keeping may be one of the highest return activities any investor can perform. Imagine selling precious metals worth tens of thousands of dollars and then realizing you cannot prove what you originally paid. Suddenly, every missing receipt becomes a problem. Every forgotten purchase date becomes a source of uncertainty. Every undocumented transaction creates unnecessary risk. Good records solve those problems before they begin. Keep invoices, keep payment confirmations, keep dealer receipts, keep shipping records, keep notes about purchase dates and quantities. Store digital copies in multiple locations. A few minutes of organization today can save countless hours of frustration years later. More importantly, it can help ensure that you do not overpay taxes simply because you cannot prove your actual cost basis. Retirees face an especially important challenge when it comes to precious metals. Many retirees hold silver and gold as a financial safety net. The stack provides comfort during uncertain times and serves as a backup source of liquidity if unexpected expenses arise. But when those metals are sold, the resulting income can affect much more than a simple tax bill. Depending on individual circumstances, additional income may influence other financial calculations that become important during retirement. That is why the timing of a sale can matter almost as much as the sale itself. Many investors also misunderstand how reporting frameworks work. Some believe that dividing activity into smaller transactions automatically changes reporting obligations. Financial regulators understand that people often think this way, which is why many reporting systems focus on the substance of what is happening rather than the appearance of individual transactions. The principle is simple. Authorities are interested in understanding the true nature of a transaction, not just how it is divided on paper. This idea extends far beyond precious metals. It appears throughout the financial system because regulators know that people often try to focus on technical details while ignoring the larger reality of the transaction. Smart investors do not spend their time searching for loopholes. They spend their time building strategies that remain effective regardless of reporting requirements. That approach creates confidence instead of uncertainty. The investors who consistently succeed over decades share one important characteristic: they think in systems. They understand that every financial decision exists within a larger framework: taxes, reporting requirements, record keeping, estate planning, retirement planning, and investment strategy all interact with each other. Most people focus only on the purchase. Sophisticated investors focus on the entire life cycle of the asset. They think about how they will buy, how they will store, how they will document, and how they will eventually sell. History repeatedly shows that wealth is not built simply by choosing good assets. Wealth is built by managing those assets intelligently over long periods of time. Silver can be an excellent store of value. Gold can be an effective hedge against uncertainty. But neither asset eliminates the need for planning. In fact, the more successful an investment becomes, the more important planning tends to be. The irony is that many stackers buy precious metals because they want more control over their financial future. Yet failing to understand tax and reporting rules often results in less control, not more. Knowledge creates flexibility. Documentation creates confidence. Preparation creates options. Investors who ignore those principles leave themselves vulnerable to unpleasant surprises. Investors who embrace those principles put themselves in a stronger position regardless of what happens to silver prices. As we move further into 2026, the investors most likely to succeed will not necessarily be the people with the largest stacks. They will be the people who understand how the system works. They will know the difference between ownership and reporting. They will know the difference between rumors and regulations. They will know the difference between speculation and planning. Most importantly, They will understand that every ounce eventually has an exit strategy, and that exit strategy matters just as much as the original purchase. The silver market will continue to attract attention. Economic uncertainty will continue to create demand. Inflation concerns will continue to influence investor behavior. But none of those trends change a simple reality. The investors who keep accurate records, understand the rules, and plan ahead are the investors most likely to preserve their wealth. The goal is not to fear regulations. The goal is to understand them, because the biggest mistake most silver stackers make is not buying at the wrong price. It is reaching the selling stage without knowing exactly how that transaction fits into the larger financial picture. And by the time that mistake becomes visible, it is often too late to fix it.